So, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending? How do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. I'm Merrill Chandler, and welcome to the Are You Effable podcast. Welcome, everybody, to Are You Effable, the podcast where you learn what the principles of fundability and how to establish what you need to do in order to make you personally and your business fundable. So I'll be back in just a moment, and we'll get started on another one of the deep dives we did at FICO World 2019. So I'll see you back in just a second. Welcome back, everybody. Merrill Chandler, your host of Are You Effable? Now, as I said before the introduction, we're going to be talking about one of the key meetings that we had at FICO World 2019. I had the opportunity to schedule an appointment with Ethan Dornhelm. He is the contact that we'd spoken with back in FICO World 2016, and we got to spend tons of great time with him and his FICO score development team, asking that 100 questions that I've referred to. Well, in the revisit, we scheduled another meeting with Ethan, and to our surprise, to our amazement, he invited Tom Quinn, the VP of Scores, to join that meeting in his stead. And Tom was actually the original developer, the manager over the development of myfico.com. One of the things that we live and breathe by. The first iteration of myfico.com in the early 2000s came from Tom Quinn. So we had a chance to meet with him, and one of my biggest questions was about what we call the FICO 150. Now, they don't call it the FICO 150 because but here I'm trying to make it intelligible to all of us borrowers, right? These reason codes are the total collection of all of the things that keep you from fundability. All right. So in the FICO score algorithm, what we learned is there are 12 scorecards, and there are 4 scorecards for negative credit, and there are 8 scorecards for positive credit. This was an update from what we previously shared in previous episodes. Now, these scorecards basically parse out the FICO 40 characteristics that are currently being measured by the bureaus. So the bureaus have the data. FICO, in each one of the credit bureau's separate databases, have an onboard scoring system. Their software is actually on the mainframe at the credit bureau. And when you do an inquiry, it goes to the credit bureau, and then the data coming back to the merchant, whether it's an auto loan, mortgage, credit card, that data coming back to the merchant passes through FICO's software. And there are each bureau has subtle differences in how they collect the data. So FICO has specific mechanisms for measuring that data. That's why in the previous episode where we talked about FICO 542, and early in the FICO 542 is from the 90s, the version of the scoring software from the 90s. 542 represents the Equifax, TransUnion, and Experian as different indicators, right? FICO 5, FICO 4, and FICO 2. Here, all of these FICO codes that we're going to be going over in just a moment, some of them, as Tom Quinn shared with us, some of them are from previous, like the 542 or FICO 8. Some of them are FICO 9, and as we talked about in previous episodes, some of them are future and forward casting that will be included in either future versions of FICO scoring software, or they're already being measured in the relationship with FICO in helping lenders develop their underwriting software. Remember, lenders, some of the big ones, we are also told in this meeting, some of the big outfits, the Chases, the top tier banks, many of them have their own scoring models where they don't need FICO's support in creating those internal performance measuring algorithms. But the tier twos, the tier threes, all of those regional banks, et cetera, the local community credit unions and community banks, all of them have who subscribe to FICO. Every one of them have FICO support in shaping their algorithms to coordinate with FICO's evaluation of your profile, right? So what we're going to be going through is kind of a broad base. There's no way that we can go through every single one of these, but I want to show you the the big things that they're looking for. And remember, these codes are over the 24-month look back period in increments of 3, 6, 12, and 24 months. And there are, at my count, there are 1, 2, 3, 4, 5, 6, 7, 8 major categories. Now there's smaller categories, but 8 major categories that we're going to be reviewing. So let's start out here. First and foremost, see how it's Experian, TransUnion, Equifax. Here's the indicator and the old version of the name, Beacon Classic and Experian Risk Score Classic. These are what were called 542. Then there's mortgage scores powered by CoreLogic. So they're showing every one of these and where they fit, which ones are actually being included in the current models. Does that make sense? So I want you to understand what we're looking at here is that they're giving us what valuations are being measured in the next gen score, which is FICO 8. But then 542 is Beacon and the 2 classics. Those scores, for those of you who are not watching this, I highly recommend you look at the graphics and or watch the video. The back graphics will be in your getfundable.com/podcast. Follow that button, find this episode, and you'll see the graphics. And a few episodes ago, we gave you a link on how to get a copy of the FICO 150 yourself. But ultimately, these indicators show which one are currently being used in which version. So for example, look at the difference between 542 and what they're measuring. So we've got here, and then there's 2 spaces. These 2 spaces means that those are being used on the next gen, which the marketing term is FICO 8. They're being used on FICO 8, but they were not being used. Look at all of these that are not being used on 542, but are being used in FICO 8. Now that we know kind of the playing field, let me show you what they're measuring. Again, we can't go into all of these, but I want you to see what's out there. First of all, amount owed. Look at all of those criteria that is amount owed. There's amount owed on collections, amount owed on delinquent accounts, amount owed on recently opened consumer finance versus amount owed on recently opened bank national cards is too high. Notice they're saying recently opened versus just amount owed on revolving accounts. So they're distinguishing between recently opened retail accounts, recently opened consumer finance accounts, and opened bank card and national bank card accounts. They're evaluating these separately. So we know that sales finance companies is too high. The sales finance companies could be furniture, it could be your auto loans. Remember how we talked about auto loans from finance companies are tier 4? That can be in there. Open revolving accounts, too high. Retail accounts, that's your tier 4, 40%, what we call the junk cards. But that's different than consumer finance company account, which are like some of the fintechs, the SoFis, the Prospers, the Marcuses from I want to say Neiman Marcus, but from Goldman Sachs. These are all, see how we have broken down into tiers the different types of accounts, because in FICO 8, they're evaluating those separately, whereas they did not evaluate those in earlier versions of the model. Now, again, they still have amount paid down is too low, amount paid down on mortgages too low, amount past due on account, bankruptcy filing. So I'm not getting there are numerous versions here, but let's go to the next page, because now notice it's lack of recent consumer finance company account. Now, That if you have a consumer finance company, but it's not reporting faithfully, you may get triggered on lack of recent data. Remember, we talked about accuracy being the key to success and repetitive, right? If it's open, you got to put traffic on it. Unless the objective is, if you're working with us and our objective is to close it, then there are strategies on how to close that once we've replaced the low value points with high value points. So lack of recent non-mortgage installment info, lack of recent revolving account, lack of recent revolving HELOC. We've got lack of recent established credit accounts. There's a whole slew of lack of recent. All right. So there's another large category that's being measured. Then there's length of time accounts have been established, length of time that they're open installment, open mortgages, length of time retail accounts have been established, and length of time revolving accounts have been established. So every one of these, there's not just lack of recent, but length of time that these things have been established. Your accounts have been open. As we've said, 3, 6, 12, and 24 months, an account doesn't even register as valuable until it's at least 24 months old. And then if you've got these lower, the retail accounts are in your way, or they don't even count well anyway. 40% of the value of a high value account, but you're ending up with you're not getting any juice because even the length of time counts against you. That's why we say in the boot camp, if you opened up a retail card in the last 3 months, I recommend to people close it and take the score hit, and it'll rebuild over the next 3 to 6 months. After 3 months, in that 6-month, 12-month category, it's that length of time is counting towards it. So we don't want to mess around with that. Now, look at the next one on this page is no recent national bank revolving balances. Remember in the 2016 FICO world, Ethan told us that less is better than more when it comes to balances on your credit cards. Less is better than more, but some is better than none. Well, if there's no recent bank card revolving balances that are reporting, you're not getting the juice from G2 as it contributes to your fundability. All right. No recent non-mortgage balance. So those are, they're saying balances on mortgages, but then there are your other installment loans, auto loans, student loans, etc. If you don't have any auto loans, student loans, or otherwise, you're not getting the point contribution to your fundability, not just your score, your fundability. That no recent revolving balances, no recent retail balances. Remember those retail balances, if you got a card, if it's registering that you have a low value card, but there's no balances on it, that means there's no traffic. That means you're not giving the algorithm something, hey, what have you done for me lately? That's why we need to close them or do something with them to maximize our fundability. All right. Next page is that we go to number of bank and national revolving accounts, number of check advance inquiries, number of collections files. So how many of these different things, number of established accounts, number of retail accounts, number of revolving accounts. You can have too much available credit. So they're literally counting the numbers towards each one of these. All right. Vital to what we're learning, guys. And then again, proportion of balance to limit on auto loans, consumer finance company accounts, on delinquent accounts, proportion of balance to limit on even accounts that are delinquent, proportion of balance to limit on sales finance. Notice they're breaking all of these out. That's why we give them tiers and value contributions. Then proportion of balance. Then down here, there's ratio of balance, and proportion of balances to limits on even your auto loans, student loans, consumer finance cards. They're calculating the limit. They're calculating your balance to limit ratios. Then finally, we go to time since derogatory public record is too short. Time since account opening is too. Time since most recent. Time since. That's another way of evaluating. Do you see patterns here? We have the global patterns, and then we have these smaller groups that I've outlined in red. These smaller groups that I'm reviewing with you are the smaller valuations that they're giving these different accounts. And then we have too few national bank cards, too few installment loans, too few revolving accounts, too few, etc. You can have too few if you are, and those too fews, even for the retail accounts, if those are the only accounts you have on your profile, you can have too few, right? We've talked about in previous episodes about what the balance or what the perfect profile looks like. But if you don't have any other bank cards or national accounts, you need to have the right number of consumer finance accounts or trade lines. Now, we don't want you to build those, but I'm telling you how it scores it. It needs enough data to establish some sort of pattern of behavior for you, hence fundability. And finally, you can have too many installment accounts, too many active autos, too many of lots of things, and too many recently opened. This is where, go back to the episode on 524, where you can't open too many revolving accounts too fast. Too many things, too many recently opened retail accounts, too many open revolving accounts. Every one of these are going to go up against you. Guys, again, can't go into all the details of every one of these, but these are the behaviors. Notice everything that we've discussed. These are the behaviors that are driving your fundability. Too many, too few, not enough, all of them. So go to getfundable.com to see the graphics of each one of these, and they will be included in there. And we've already offered the opportunity to be able to get the PDF of all the reason codes. This is what it's about: getting into the details and finding out what behaviors they're measuring. I've just given you an example and the resources to discover it. And the only thing is every single one of those behaviors has a custom application to you. So if you would like to know more about that, go to getfundable.com, click on the bootcamp, join us, fill out the fundability documentation, and we will make sure that you have more answers than just reviewing kind of the high level view. You'll get answers to your personal questions. So this is Merrill Chandler. My intention is every single time that I do these podcasts is to make sure you are effable. You have a spectacular rest of your day. Hey guys, thank you for listening to Are You Effable? Please leave comments because I would love to read about your aha moments from this episode. And be sure to visit fundinghackers.com to view the blog post, get important links, join our community, and much, much more. And you gotta tell your friends about this podcast. We want them to become effable too.